Beyond Meat Inc. is currently trading at a price of 0.99 USD as of the market close on January 16, 2026, which represents a significant intraday decline of 5.25%. In the after-hours session, we are seeing a minor bounce of 0.47%, bringing the price to 0.9946 USD. For a company that once carried the mantle of a sector leader, the drop below the $1 mark is a psychological and technical nightmare. The expectation in the broader market is that Beyond Meat is essentially a dead company walking, a penny stock victim of a food trend that has soured. But the reality that hit the headlines just 24 hours ago is far more surprising. Ethan Brown has officially moved the company into the liquid beverage market with the launch of Beyond Immerse. This isn't just a new burger, it's a total pivot into functional nutrition, and it creates a curiosity loop that most investors haven't processed yet. Can a brand built on burgers successfully rebrand itself as a wellness drink company? Or is this simply a final frantic attempt to diversify before the debt clock runs out? The tension between what investors see on their screen and what the company is doing behind the scenes is at an all-time high. When you check your individual brokerage on the Robinhood app or look at your tech-heavy positions on the Fidelity mobile app, you're likely used to seeing red across the board for plant-based names. The common belief is that the plant-based category has reached structural stagnation. The reality, however, is that Beyond Meat is systematically shedding its meat identity to survive. They're even dropping the word meat from some of their branding in a bid to distance themselves from the highly processed narrative that has plagued the stock for years. This is a classic expectation versus reality setup. The market expects a slow slide into bankruptcy, but management is aggressively pursuing a transformation into a broader plant protein company. Whether this pivot can happen fast enough to outrun the $1.2 billion in debt is the billion-dollar question that is currently paralyzing the stock at these sub-dollar levels. Today's trading volume was a staggering 45 million shares, which is nearly double the average daily volume for January. This suggests that we aren't just seeing retail panic, we are seeing a massive capitulation event, where older institutional holders are likely flushing their remaining positions into the hands of speculative traders. If you use Interactive Brokers or the SoFi trading platform, you've probably noticed that the short interest remains incredibly high, hovering near 28% of the float. This means that every time there's a glimmer of news, like the Beyond Immerse launch, we see these violent, short-lived pops. But the reality of the balance sheet is a heavy anchor. With only $131 million in cash and a debt-to-equity ratio that is practically off the charts following the massive debt for equity swaps of late 2025, the company is in a race against time. The expectation was that the debt restructuring would save the stock. The reality is that it only bought them a few more quarters of life. The recent movement is also being weighed down by a new investigation from Pomerantz LLP into potential securities violations. This adds a layer of legal risk that institutional wealth management teams at places like Fidelity or Schwab are simply not willing to touch. When you use Schwab Intelligent Portfolios or other automated online investment tools, you won't find BYND in the mix because it has failed almost every quality and stability filter in the book. This leaves the stock in the hands of the self-investing community and the high-frequency traders who thrive on volatility. If you're managing your own individual brokerage account, you're essentially watching a high-stakes survival movie in real time. The stock is down 78% over the last year, a figure that is hard to digest when you compare it to the massive gains seen in Nvidia stock or even the recovery in Tesla stock over the same period. Comment below how many shares of Beyond Meat you are currently holding, or if you've decided that the plant-based sector is a losing bet. Do you think the new Beyond Immerse drinks can actually compete with the likes of Celsius or Gatorade? Let's look at the actual business model for a second, because it has been fundamentally altered. In 2024, Beyond Meat was a company that lived and died by its retail burger sales. Today, their new Beyond Ground product line doesn't even use the word meat and features only 4 clean ingredients. They're trying to solve the health concern that drove so many consumers back to traditional animal products. The expectation was that they would just keep making better burgers. The reality is that they have abandoned the mimicry model in favor of a nutrition model. They're launching protein beverages because the margins on liquids are significantly higher than the margins on frozen patties. In their most recent report, gross margins were a measly 8.5%. For a food company to survive, they need that number closer to 30%. By moving into functional drinks, they're aiming for that high-margin goal, but the competitive landscape in the beverage aisle is even more crowded than the meat case. If you are a regular on investing sites or frequently engage in online investing, you know that the valuation of Beyond Meat is a polarizing topic. Some see a $500 million market cap for a brand that still does $300 million in annual sales as a steal. Others look at the $1.2 billion in debt and realize the enterprise value makes this one of the most expensive companies in the sector. This is the reality check that often gets lost in the social media hype. When you see a stock bounce 10% on the Robinhood app or look at your tech-heavy positions on the Fidelity mobile app, you're likely used to seeing red across the board for plant-based names. The common belief is that the plant-based category has reached structural stagnation. The reality, however, is that Beyond Meat is systematically shedding its meat identity to survive. They're even dropping the word meat from some of their branding in a bid to distance themselves from the highly processed narrative that has plagued the stock for years. This is a classic expectation versus reality setup. The market expects a slow slide into bankruptcy, but management is aggressively pursuing a transformation into a broader plant protein company. Whether this pivot can happen fast enough to outrun the $1.2 billion in debt is the billion-dollar question that is currently paralyzing the stock at these sub-dollar levels. Historical context is important here. Beyond Meat was the darling of the 2019 market, reaching a peak of $234 USD. The expectation was that they would be the Apple of food. The reality is that food is a commodity business with brutal logistics and razor-thin margins. Unlike Apple stock, which has a software ecosystem and high switching costs, or Nvidia stock, which has a technological moat that rivals can't cross, Beyond Meat found itself in a price war with giants like Tyson and private label brands. They were forced to offer steep markdowns just to move inventory, which crushed their profits. The older reports from 2022 and 2023 are a graveyard of missed expectations and material weaknesses in internal controls. Management has spent the last year trying to right-size the operation, but the revenue continues to shrink, down over 13% in the crucial U.S. market. Looking ahead, the future outlook for BYND is entirely dependent on the second half of 2026 goal of becoming EBITDA positive. This is the timeline management has set for their transformation. The catalysts to watch are the initial sales data for the Beyond Immerse drinks and the potential for any further partnership deals. The expectation was that the PepsiCo joint venture failure was the end of their big-name alliances. The reality is that they are still a globally recognized brand, and a clean product line could attract a new type of partner, perhaps a health-focused retailer or a global gym chain. But the risks are immense. If they can't get the share price back above $1, they face the reality of a Nasdaq delisting or a forced reverse stock pledge, which almost always triggers more selling from retail investors on the SoFi Invest app or through Fidelity mutual funds. The macroeconomic pressure is another factor that often gets ignored. In a high inflation environment, consumers are less likely to pay a premium for noble food choices. The expectation was that the price gap between plant-based and animal meat would close due to technology. The reality is that traditional meat has stayed relatively affordable, while the cost of specialized pea protein and potato starch has fluctuated wildly. This has left Beyond Meat in a no-man's land, where they are too expensive for the budget shopper but not clean enough for the hardcore health enthusiast. The new Beyond Immerse line is their attempt to finally capture that high-end, health-conscious consumer who is already spending $5 on a protein shake. Institutional wealth management firms are largely staying away from this story until the securities investigation and the material weakness issues are resolved. When you are doing your own online investing or seeking investment help, you'll notice that most analysts have a strong sell or underperform rating on the name. Mizuho and TD Cowen both have price targets near 0.80 USD, which suggests there is still room for more pain. The reality of the 0.99 USD